sold! Congratulations, you have just sold your house and for a profit! But then you might be thinking, oh, what about taxes? In this video, we're going to be talking about capital gains tax. Capital gains tax is a tax on the profit of a sale, in this case, the sale of your house. The profit is the sale price minus the amount that you purchased your house for. I'm going to be talking in general terms, but for your specific situation, I recommend contacting a CPA to make sure that you have your figures and filing your taxes correctly. When you sell your home for more than you purchased it for, you have capital gains, which might be taxed. However, if you have lived in your home for 2 out of the last 5 years, there's a chance that you qualify for an exemption that could cover the capital gains tax. For a single homeowner, there's a maximum exemption of $250,000. For a married couple filing jointly, it's $500,000. Here's an example. If you're part of a married couple who bought their home in 2012 for $350,000 and you sold it now for $700,000, congratulations! All $350,000 of profit is exempt from capital gains tax because it doesn't meet the minimum $500,000. But maybe you bought and sold that same house as a single person. Now your $350,000 profit exceeds the $250,000 limit, which means $100,000, $350,000 profit minus the $250,000 exemption, would be taxed at a percentage based on your income. Most likely it'll be 15%, though it could be higher or lower. So in this situation, your capital gains tax on your $350,000 profit would be $15,000 because the tax rate is only applied to the amount that wasn't exempt, 15% on the $100,000. But it is actually even less than that. You can adjust both the purchase price and the sale price. If you put on a new roof or add a fence to the yard or add a bedroom, all of this is investment in the property, which can be added to the purchase price. Accountants call this adjusted basis. By raising that number, the difference between the purchase and sale gets smaller, and your taxable amount goes down. You can also adjust the sale price down by subtracting some of the costs of selling your home, like recording fees, title fees, commissions. Accountants call this amount realized. Let's apply this to our example. The sale price of $700,000 gets adjusted down to the amount realized of $658,000. The purchase price gets adjusted up from $350,000 to $365,000 for your adjusted basis. Now your profit for tax purposes is $293,000. But remember, $250,000 was exempt for this single independent homeowner. So the taxable amount is just $43,000. And at a 15% tax rate, that's a tax of only $6,450, which you should set aside now so you have it ready to pay come tax season. Without making adjustments, your tax was $15,000. After your adjustment, it was only $6,450. And you have to remember, you just sold your home for $700,000. That's less than 1% of the sale of your home. Now you might be thinking, I've heard something about I can use the profit from the sale of my house to purchase my new house and not have to pay capital gains. What you're thinking about is a 1031 exchange. That is when you sell a rental or investment property and use the profits from that to buy a similar investment property. And even then, you still have to pay capital gains tax when you sell that property. You're just deferring the payment. So, in general, if you sell your home for a big profit, there might be capital gains tax. However, most of us apply for an exemption that will either cover all of it or at least some of it. If you want to know more and get all my updates, subscribe to my YouTube channel. If you have any questions, send me an email or put it in the comments below. Thanks for watching.